Hello, everybody. Welcome to Friday and another Talk Money with Tom show. Really looking forward to answering your questions today. The format of this show is pretty straightforward. We answer questions. The objective is to help people have a more successful retirement. Whether you're looking forward to retirement or you're already in retirement, we can help you if you want to send us your questions. Eason is here. He's going to be the moderator. You send the questions into Eason at the Ask Tom email address there, or you can use the chat window. And you can actually send in the questions on the email basis at any point in time. We generally do get some during the week. We'll cover some questions that come out of our strategy sessions and dealing with the clients, because I think that's an important thing for everybody to hear, some of them. So really fun setup as far as that goes. If you want to continue to get educational material from this channel, you can subscribe to the channel by hitting the subscribe button, hit the little bell so you get the actual video notifications. You can join our email list by sending us your email address, or you can actually set up an appointment on our website there. There's a book appointment button where you can set up a 30-minute phone or video conference, and we can talk to you about something custom in terms of your specific situation as far as that goes. So really enjoy this format. We have some great questions. It's been a really good time. We will not be doing this next Friday, just because, again, it's, Thanksgiving Friday as far as that goes, but we'll be back the following Friday after that. So look forward to seeing you then too. All right, I always like to start off the show with a little bit of a summary of what I saw happening in the market this week. And really, this is a very good week altogether from what we've seen. Last week, we had the big drop that happened from the inflation number coming out, and we basically have recovered, that. We've had an all-time record close yesterday for the S&P 500 and the Nasdaq, for example. So things are going really well. There are some specific things that are probably worth noting, but I want to really talk about one reported number that came out this week. There is a thing called the leading economic indicator, and it's one of my favorite indicators to watch for economic growth or lack thereof. And I think if I had to follow one indicator, this would be it. So let me share my screen and I'll show you kind of a chart of what it looks like, and I can explain what it is. And I think this might help, you to understand what's going on and such too. I do try to point out some of the things that are going well to compensate for some of the things that we keep seeing in the news, that are negative. Somebody saying that the market's going to crash and all of these different things that happen. And the reason they do that is because they get more clicks on their articles and such, and obviously they're making more money off of that. So the positive side sometimes get ignored, but I think understanding this index, understanding what's happening with this index right now might help kind of balance out your thought process for investing. So this is called LEI, Leading Economic Indicators, put together by the Conference Board. And this blue line, right, is the actual indicator. This goes all the way back to 1960. These gray bars in here are different recessions that happened. And let me describe the indicator. It is actually a basket of 10 other indicators. So there's 10 of them altogether. A group of them revolve around manufacturing. So for example, how many hours were worked during manufacturing over that last month, how many, capital goods orders came in, consumer orders, the volume of orders, etc. And then there's a grouping around the consumer, for the consumer health. They got a consumer survey, building permits, for example, and those types of things. And then they look at the financial health of the markets as a whole. And the S&P 500 is one of the 10 indicators in here, which I really like, as well as money supply. And then the difference between long and short-term interest rates, which is an economic indicator. So this is, in my opinion, a quite accurate indicator. And here's how I look at this. If you look, every time you see one of these gray bars, you're generally seeing the indicator start down first. That's why it's called a leading indicator. And so if you look here, it starts down, then we got a recession, starts down, recession, starts down, okay? So what we want to note here for starters is that it's not even close to starting down. Matter of fact, in October, it actually went up 0.9%, which is a fairly big number for this particular indicator. And what that says is that the indicator is saying that the economy is expanding right now as we speak, and that the economy will most likely continue to expand, through the end of the year and the first part of next year. And then we'll see, this comes out every month and we get to watch this. So one of the things I look at is that if this indicator is not going down or even sideways, the chances of a big stock market crash are very small, at least historically. So if you look here, this big recession here, you had the topping of this indicator way before that. This was the 2008 downturn. And again, here's the 2000 downturn it topped before. So it gives us some early warning if something's going to happen. We go back to the other large downturn, which was here in 1973. Again, it peaked first before we had this big downturn. So this was 46% down, 2000 was 49% down, 2008 was 57% down. So this is all for the S&P 500 as far as the returns go. So here's my thing. When you see an article that says the market's going to crash, we're going to have the worst crash ever, all these things that we keep seeing all the time, think about this chart, because what this chart's saying is from 1960 to now, we've not had one single time where this indicator was going straight up and we ended up with a big market crash or even a recession. And so anything can happen. Things can be different, those types of things. But altogether, I think it's important to understand how something like this works. And I'll keep you up to breast on this as far as that goes. And I'll even let you know if it starts to top so we can start to figure out what that means and what we might do for that. And then the other chart I'll show you just real quickly. This is the S&P 500. Each one of these little boxes here is a day. This orange line here is the 50-day moving average. We've got the 200-day moving average. So first of all, when you look at this over the last year, that's a pretty good slope. I mean, this is pretty strong. We had this one time period here where it fell below the 50-day moving average, and that was during the period of time where they were worried about the debt ceiling. We actually got defensive in that time frame and then got back in at a lower point for most of what we dealt with in order to make sure we were okay on the debt ceiling. The debt ceiling is still an issue, or something that, we're going to be dealing with here possibly again, although I think it's probably going to be resolved, but we have enough money to last till December 15th, which isn't that far off. But if they get the Build Better Back program passed, they passed the House today, it goes to the Senate, they'll probably change it. And then if they do, they have to vote on it. If it gets past that, they'll come back to the House and they'll probably do a pretty quick vote in the House and it'll go through. And in that bill, we have the debt ceiling increase in there too. That should get us to December of 2022. So anyway, I think that those things are kind of being factored in right now. But this is a very strong market. We're seeing motion in certain segments. So software, for example, doing quite well. A company like Microsoft, for example, they don't have supply chain issue because they deliver their product without having to assemble something like Apple does. We're starting to see a fantastic movement out of that group as far as that goes. We're also seeing good movement out of the semiconductor group as a whole because of the fact that that's one of the areas where we have the biggest supply chain constraints, and they're working pretty much around the clock to solve those constraints, and that means profits. A lot of these companies have orders booked out on some of their chips all the way through next year. So that gives them pricing power, so they don't have to worry about inflation too much in that regards. And it also gives them, really good revenue stream as far as that goes. So, altogether, this has been a fantastic market. It's a really good time to be an investor. We're seeing some things happen here that I think are just accelerating as far as that goes. I don't see that acceleration stopping. That leading indicator line, if you looked closely, it's accelerating upward. That's a very strong line. Even if the Federal Reserve starts to pull back, and those types of things, I think we still see some pretty good motion for quite a while there in terms of economic growth. So that's what I see this week. Altogether, great week, and so hopefully we can see what happens. Next week's going to be a shorter week. We got the Thursdays off, and Friday's only a half day, but nonetheless, we'll see what happens there. All right, Eason, let's get into some of the questions. What do we got first?
Sure. So the first question is, what is a charitable remainder trust? I've heard about it in the news a couple times, and it seems like a kind of, what can I do with this?
Yeah, charitable remainder trust, basically you can place an appreciated asset. I've had clients that have sold properties, either current home or rental property. And you can even place a portion of the asset into this charitable remainder trust. And so let's say I bought a home for 100,000, now it's worth $1 million, and it's a rental property. I don't want to hold on to it anymore. I don't want to deal with the tenants and whatever it might be. So I put that house inside the charitable remainder trust, and essentially I get an income coming out of that trust. Let's just say 6% that comes out of that trust for the rest of my life, and the remainder goes to the charity. Whatever's left, after I pass away, goes to charity. And so what happens for us is we end up with those in terms of the asset management. So we'll create a portfolio with the money from the house sale. And you don't have to pay taxes on the house sale. So you pay 100,000, it's worth $1 million. If it's a rental property, you might have written it down on depreciation, so you end up with a big gain. And if you put it inside the charitable remainder trust, there is no gain. And so the full $1 million in that case would go into this portfolio, and you get your 6%, or different numbers that you can choose on how much you get, and there's different ramifications for that, which is beyond the scope of the show. But nonetheless, that's what a charitable remainder trust is. In terms of, lawyers are better at understanding what they are and exactly how that works. Tax accountants, tax lawyers are even better at understanding how those work. What we end up doing is managing the asset and having that distribution go on, and then, passing it through to the charity when that person passes away. So I've seen people put their highly appreciated stock in those. Seen people put a portion of their home as they sell it and move someplace cheaper, and I've seen people put their rental property. So that's what I've seen, and all of it is to avoid the capital gains tax, as far as that goes. So the one downfall would be, of course, there's an accounting issue. They're a little bit difficult to account for. You have to do it every year, but instead of it going to your kids, if you have any, or your beneficiaries that you might care about, that money's going to the charity. And so again, some situations where people don't have kids, or there's not a big issue there as far as that goes. So you have to weigh that as part of the scenario. But yeah, that's a valid strategy. We've run into them a fair number of times.
Yeah, and one of the a little bit less common is the charitable leads trust, which is kind of the opposite, where the charity gets the income, but the remainder goes to your beneficiaries. And so that also provides another way to, like, say you don't need the income now, but you want it to go on to your children. This is a good way to get it out without,
Yeah.
avoid some of those taxes.
Yeah. Yeah, exactly. These are all strategies that we can talk to you about. If you have some additional questions, take a look at what those numbers would look like and whether it makes any sense. We can even model these types of things inside the financial planning software. So there's a whole bunch of different areas there that are interesting. There's pros and cons, and we can certainly talk about what those are, especially from the standpoint of how the investing works, because that's where we come in.
Yeah. So our next question is comes from a comment that was on one of our YouTube videos. And so the IRS, do you think there would be ever a curveball where they tax Roth? You can look at they happen to Social Security with what they call a provisional income now, and with that double taxation.
Yeah, this is kind of a common comment I've seen. We saw it on one of our videos, and we've seen it. I've seen it other places also. So the thought is, hey, I'm going to put money into this Roth IRA, and you can do so, through a conversion or through actual money that you put in if you qualify, and it's going to grow tax free. And could they change the law so it actually doesn't grow tax free? And I should have maybe just put it in a regular IRA or a regular 401k. And they often cite the double taxation situation on Social Security. So what happened was, Social Security originally, when it came out, was completely tax-free. And then they set up a scenario where if you're over a certain level of income, they were going to tax Social Security. And Social Security sort of is a tax, right? It comes off your paycheck. It goes out to people that are currently getting Social Security. And So that's what looks like double taxation. But I don't know if it's a great correlation. I mean, you're talking about a government kind of pension program that is designed for a low income. I mean, if you look at Social Security very closely, it is designed to help somebody who really doesn't have much else. And if you have, and it's not just the taxation, for higher income earners, it is also the way the calculation is done. For those people that put in very little, they get a lot more back than on a ratio basis than those people that put in a lot. So versus a Roth IRA or a Roth 401k, that's literally your asset. Um, I've never seen anything like that where they've changed the rules on that. And I do think, let's say I have $100,000 that I've converted from an IRA to a Roth IRA. I pay my tax when I do that conversion. Maybe they could change it at some point in time to say the growth on that would be taxable when it was supposed to be tax free. But taxing me again on that $100,000, I don't see it, honestly. I think I think that the concept though of having an even or some form of distribution between taxable assets, tax deferred assets like an IRA, and tax free assets would the one big advantage of that is that as they change tax laws, they increase capital gains, they lower capital gains, they make Roth taxable, they don't make Roth taxable, they change the RMDs on the IRAs, for example. You diversify your risk amongst tax law changes by having money in all three of those buckets, which is what we advocate as far as that goes. I'd probably want to have more in a tax-free bucket than a tax-deferred bucket if I had a choice. But having something in all three kind of protects you from those kind of changes. So anyway, that would be my thought process on that. I wouldn't worry too much personally about the taxation issue, but keep it diversified, and we can try to figure out what to do.
Do you feel it's like more likely that they'll cap the amount of money you can have in a Roth and just like say anything above this number is you have to take it out and then you start paying taxes on that those gain or whenever those actually increase from investments? Is that like a better way to tax it? So like you still maintain like tax-free Roth,
Right.
but you limit the I guess the billionaires or someone from abusing the system.
Yeah. Well, that's what's in the Build Better Back Better program right now that just passed the House today. Is that if you have more than $10 million in a Roth IRA, you have to distribute that. It's not taxable, but so let's say you have 11 million. You got to take a million out and put it in your taxable account. And then the growth thereafter on that million would be taxable. And then the next year it grows to 12 million. Okay, got to take out 2 million that year, but it's not taxable. So that's what they've got in there right now. I don't have any clients that have more than $10 million in a Roth IRA, for example, in this particular case. Um, and I'd be a little bit cautious even talking about this because that was passed in the House and it still has to go through the Senate. We'll talk much more concretely when this thing's all passed and we know what we're dealing with. But that's what they're trying to do right now is making it so that somebody who has a giant Roth won't be able to keep it growing tax free till it's $1 billion or whatever. And there's, a story of a $5 billion Roth out there that, somebody put their founder stock in a Roth IRA and it obviously grew. So that situation would be capped at $10 million. I think that's fine. It was designed for kind of that, average Joe to be able to have some way to have a good retirement and save tax free. I think the Roth thing would be really fine if that's what they end up doing personally. But anyway, so there's a whole bunch of pieces that are going to affect the Roth. Again, we'll talk about them more when it passes because it's changed, I don't know, 3 or 4 times already just in this process. So it still has to go through the Senate.
Yeah. So this is a question that kind of pertains to a lot of people have been doing remodels, kind of updating their houses. Like, how does that increase, or like, does that increase my property tax?
Yeah. Well, personal experience with that. The house that you're seeing behind me here, this picture, here in Willow Glen, we bought a home that had actually jumped at least partially off of its foundation in the '89 earthquake. We bought it in 1995, and the people had continued to live in there. The floors were sloped at a pretty good degree. It was kind of amazing. And so we tore that house down and built this house. My grandparents built a house in 1936 in Willow Glen. It was always my dream to do so also. And there aren't any open lots really. So, and what happened was, I paid for the house and I had a property tax based on that sale. And then when I changed the square footage, we basically doubled it. They came out and did an appraisal on our improvements, and they increased our basis. And then that's where my taxes run off of, is that basis, and they continue to grow as far as that goes. So, yeah, that's what would happen. I believe what happens, and I'm not an expert at that particular question, but I believe that if you just do some type of a kitchen remodel or something along those lines, there is no increase in your taxation. It's triggered by a change of square footage, but I could be wrong on that. But that's how it worked for me, and I think that was fair enough. I was fine with that. I'm pretty happy with my property taxes because that was done back in 1995. So good numbers.
Yeah, and also it depends on your county. Every county has a different assessor or something like that. So
Yeah.
what what is considered just a like, refinishing like a simple like updating could be different under each county's laws or something like that.
Yeah, I do think that, I mean, to answer the question, I do think there's a possibility it changes your taxes. So, the answer is yes. How much or how, it does probably depends on what county you're in as far as that goes. But it's something to think about as you're doing a remodel, whether that would have any impact one way or another, and probably something to figure out before, you start the process. So it's a good question.
So another question is another housing question. What are your thoughts on buying a multifamily property as the first home and renting out to other units?
Yeah, I've thought about that a couple times, and we really think it's a great idea, especially for somebody who's going in to buy a home for the first time, might struggle somewhat to pay the payment, go buy, say, a duplex, right? And if you look at the price of duplexes, they're not that much more than single family homes. So you go in, you buy that, and now you got half of that residence is going to be rented. Now you got to live next door to your renter. I mean, there's all kinds of pros and cons there. But I think that's a really interesting idea and a good way of kind of getting into the market, generating an income. Rental income is awesome. It generally grows with inflation. And so theoretically, you could get a renter that's paying a big chunk of your mortgage. And so it allows you to have that capability. I would think even in the buying process, if there already is a renter, you might be able to get kind of credit for that as part of it. So maybe that would be easier to qualify for. I'm not a mortgage broker, so I'm not exactly sure how that works, but that makes sense to me. So I actually like that concept. I think long term, personally, maybe it's better to be in a single family home so you're not living right next to your renter, but you can get in the door that way and then maybe rent them both out and keep that place as a rental and then move into your single family home, right? But I think it's a good start step, is to look at that type of situation, a triplex, a fourplex, or a duplex, for example. And there's some nice areas that have duplexes here, that you can you can get a nice location, which is important too.
Yeah, and do you also have to remember, are you willing to go through the hassle of dealing with renters and what happens if it goes vacant for prolonged period of time because just the market's cold or something like that? And so you have to also be wary of the loss of income too.
Yeah, exactly. I mean, it's not a guaranteed income source, and generally speaking, it's really nice to not have any turnover because every time somebody leaves, you generally would have to fix it up at least somewhat so to get it ready for the next renter versus keeping somebody in. We always advocate to be under market, at any point in time. So if the average is 2,000, be it 1,800 or 1,750 or something, even though you're collecting less than what you might be able to get at market rate, you're not getting turnover because that person's paying 1750. They go look, and they'd have to pay 2000. They're going to stay, unless you want them to leave. That happens. But so yeah, I think that there's some risks there that have to be considered. But um, at least in this area, rents have been really good for a really long time, and they're not building a lot of new homes. So homes are getting so expensive, people can't buy new homes, so they end up renting. We still have job growth here. This is not a bad place to do that. That's for sure here in Silicon Valley.
Yeah. So earlier you talked about the House passing the spending bill. Does that have any effect on the market, or does it really not matter until the Senate kind of goes through and like has all their changes and then passes it?
Yeah, it's interesting. I mean, if you look at right now, the S&P 500 is down 0.08% today. So the House passing didn't have a positive impact. I think that the Build Better Back program won't have a big deal impact on the market except in one area. The bill itself is, I don't know what it'll end up being, but let's just say it's 1.9 trillion. It's spread out over 10 years. So the spending impact coming into the economy will be somewhat muted. I mean, in January, we had a $1.9 trillion COVID relief bill that came out. That pretty much came out all at once. That can have an impact. And it's partly why we're seeing such, motion in the markets and inflation and those things possibly also. So I don't know that it has a big impact on the market, but here's where it might. It will include the debt ceiling increase, from what I've read so far. That's a big deal because, and I do believe we could see some jump in the market because right now the debt ceiling, is needs to be increased before December 15th, according to Janet Yellen just recently. And so as we get closer to December 15th, there's going to be more and more risk managers like me taking risk off the table because a debt ceiling debt default is catastrophic. And so that would then come back onto the table, just like it did back in early October. So I do think that would have an impact on the market, but not for what everybody's thinking about in terms of just the spending. I think it's this. There's one part of politics that has a really big impact on the market, and that's that debt ceiling limit increase that has to be done on a regular basis. So that we've never defaulted, probably won't, but if we did, it would be bad. So got to be careful. Yeah, but I think that's where the bang for the buck would come from. So hopefully they get this done pretty soon because it's just going to be kind of a pain. We got a great market going. Let's keep it going. Let's pass this thing or not, one way or another. But let's get the debt ceiling, fixed. Let's go. Let's get it going till December of 2022.
Yeah. So another kind of market related question: with so many people changing jobs and other people, being recruited, how do you value like a ES or a stock ownership option plan or a stock employee stock purchase plan when looking at offers?
Yeah. So in my own family, one of my relatives was offered a job at two places. This was a while back, but early 90s, mid 90s. So had a offer from Hewlett Packard and an offer from Cisco. Right at that time, Cisco was all of 250 people. Right, so small company, um, and so she asked me to do an analysis on the two companies just from a standpoint as a stock, and so I think whether or not the company offers a stock option program of any type, um, you need to take a look at the company from the standpoint as if you were going to invest in it. And which one would you rather invest in? And so I told her, well, I would invest in Cisco. Matter of fact, I did. That's where some of the money came from to build this house. And I actually found it because of that research I was doing for her. She took that job, and the rest is history. She did really well with those stock options up until 2000. When the market had a hard time with all of those stocks. So That would be my recommendation. You know, the program itself is important. How many options you can get, how fast you can get them, what the vesting schedule is. You know, all of those things are important. But if this company isn't going anywhere and they're not growing, and on hindsight, the differential between a stock option program at Hewlett Packard from mid '90s to now versus at Cisco, you were a lot better off at Cisco, even if they gave you less options. So I would start with the analysis of the company and dig into the financials, especially if it's public already. That makes it easier. You know, what are their revenues? What's their earnings growth? What do the analysts say about that stock? What are the expectations for, you know, growth over the next 2, 3 years? Those types of things. You need to kind of analyze those pieces like you would an investment. You know, what does it look like on the charts? And, you know, is it just, you know, languishing or not? What's the relative strength of that stock versus the market at this point in time? All of those things. Those are more important to me than the actual program. That would come first. Pick the company that I liked that had the best, you know, possible rates of return in its stock. And then if you had some tiebreakers, it would be which one gives you the most in terms of those stock option programs.
So how does that differ when you're talking about, I guess, pre-public companies, you know? Say you're looking at like one of the tech startups in the Bay Area. Do you put kind of a value on having the option to buy like stock from these pre-IPO companies, or do you want to like look more for hard benefits that you can evaluate?
No, I'm personally, if it's me, I'm definitely looking for that big payoff. If I'm going to go that direction and I'm working for a pre-IPO company, a lot of those companies do have some valuation metrics because they've been through some seed capital. At least you can ask some questions about that and see what, you know, the company was worth, you know, in the last round of venture capital seed money that came in, that type of thing. You know, it's a little bit harder to really dig in and figure out. You can't look at a chart. There's no, you know, financials that are very easy to see. It also probably depends on how much in demand you are. You know, what you know, it's one thing to be, you know, if you're begging for the job, they're not going to maybe tell you as much as if they really want you. And then you might be able to extract a little bit more data about how that company's doing and what the expectations are and when they might go public. And I would be probably more concerned then about what I was being offered, you know, how many options and how fast, what's the vesting schedule, you know, that kind of thing. So, yeah, it's a little bit different in the pre-IPO arena, but yeah, that can work. You know, Instagram was what this little company. I think there was 9 people working there in this little office in San Francisco when Facebook bought them for $1 billion. There was a few people there that made some good money. You know, so for every one of those, unfortunately, there are a whole bunch that we never heard of before because they didn't work. But it's still. Matter of fact, I had a neighbor across the street that went through 3 of them, and none of them ever quite made it. So you know, he worked very hard as you don't normally do at those firms, and didn't get a payout. The options package didn't matter because the companies never got public. But you know, so it's one of those risks that you take. But that's what you should be probably doing in a company like that, to be honest, especially if you have a good skill set, is looking for that kind of home run scenario personally. Um,
Yeah. So another question is, you know, I'm interested in possibly moving, but it's really overwhelming. There's so many things to think about. Do you have any like suggestions around that?
Yeah, this came from a question from a strategy session I had with a client, and so they're, you know, they're interested in moving, but it's just kind of overwhelming. And they were talking about, you know, just the literally the physical act of moving, and how they were going to be able to do that. You know, they've accumulated a lot of things, and you know, it just seems like mind-numbing to them to have to actually pack all this up. And you know, there are companies that will come in and you know take care of almost everything for you. So you're at a point where you're just pointing your finger essentially and saying what happens as far as that goes. You know, you have to have some money to make that work, but In this particular case, as long as there's money there, that probably can be solved with money. The next thing really was, they weren't sure about where they wanted to move. And so I think that's interesting too. And because I believe that you got to have an idea of that you feel really good about, right? You got to have a place that you can kind of visualize and say to yourself, wow, I can't wait to get there because I want this or that or, whatever it might be. And so I think that's the first step. Find where you want to go. Go visit, go stay there for a while, go stay at someplace else. Just keep taking little trips to all these places that you're interested in and look at what's there and see how much you like it. If you have a long enough period of time, maybe you can visit during different seasons and see what it's like when it's hot or it's cold, right? That kind of thing. I did recommend to them very strongly that they take a look at the medical facilities. That's something I've talked about quite a few times, just because, you don't want to move into a place where the hospitals that you really need are really far away. And then all of a sudden, something happens, you get Parkinson's or cancer or something along those lines, and you're, having to drive 3 hours for your treatments and such. You're going to end up leaving that place if that does happen. So, but I do think the motivation is to find that place first. And there's all kinds of online searching capabilities for finding different locations, maybe a college town or whatever it might be. You got to have that. You got to have that motivation, have that idea in place, and then I think that'll propel you to execute everything else that you need to do to make that happen. Because I would think it's going to be a little overwhelming for almost everybody. Moving's not easy, but if you're going someplace you're super excited about, it'll be a little bit easier.
Yeah, like one suggestion I have is that say you have a city that you possibly like, maybe, rent an Airbnb and one where
Okay.
you're actually staying with
Yeah.
the host is still in the house.
Yep.
Then you have someone that you could kind of like Q&A off of in a sense.
Yep.
And like you get a feel of the neighborhoods. It's a lot, if you're visiting places, try and actually go to like the actual homes and areas, and Airbnbs are a great way of doing that.
Yeah, that's a good point. That'd be better than a hotel to a certain degree, because you're in one of the homes, and like you say, if the landlord is there and they're renting out a room or what have you, you got a resource that you might be able to talk to also. So yeah, that's a great idea. I like it. It's just I do think it's important to try to find the right place. It's not that easy. Making sure that you don't have to move again. If you're having trouble moving this time, moving the second time is going to be just as bad. So try to get that right. That sounds like a good strategy. Get out there, stay there, see what happens. Yeah, it's great. Good suggestion.
Yeah. So something that we've noticed over the last couple of weeks is there's been kind of like this divergence between like the Dow Jones and the S&P 500 and Nasdaq. Is there
Yep.
any like specific reason that's happening, or is like should we worry about that?
Yeah, it's a good point. The S&P and the Nasdaq, for example, yesterday set a all-time record close, high. Well, the Dow did not, right? So there's, kind of this weird divergence that happens, on a regular basis, but it's been a little bit more pronounced recently. And one of the things you have to realize is the structure of these different indexes. So the S&P 500 is 500 stocks chosen by Standard and Poor's, and they're weighted by how big they are. So what they call the market capitalization. So the number of shares times the price per share is your market capitalization. So Microsoft is the highest weighting because it's the biggest company right now in America. So, and then you get to the NASDAQ, which has the same weighting, but it's mostly geared around technology stocks because that's how they launched those companies when they went IPO. They went IPO on the Nasdaq. Apple and Microsoft, for example, are on the Nasdaq. So that's mostly tech driven. And then the Dow itself is 30 stocks. So Nasdaq's 1,000, and then the 500 for the S&P 500, only 30. So it can do all kinds of weird things, and it's actually weighted based on price, which they don't do anymore. But the Dow goes back to 1883 is when it was first put in. And the reason it's only 30 stocks is because that was a pretty good representation of what was happening back then. There weren't that many stocks. Now it's too small to really mean anything. Although I would say on average, my clients know more about the Dow than anything else, even though it's probably the one index that doesn't have the best representation of what's going on. But just recently, we've seen, a movement towards companies that can do well in an inflationary environment where you've got low labor, tight labor market and a messed up, supply chain. And a lot of those are tech companies, and those are on the Nasdaq, for example, and they're also pretty prevalent on the S&P 500. And so you've got a lot of older companies like Caterpillar and what have you. So Caterpillar could have trouble delivering things just like, say, Ford or GM might, because they need, all these pieces from the supply chain that aren't coming through. But one of the big things that's happening on the Dow is Visa. So Visa charges, the merchants a certain percentage for every, purchase, right? And so Amazon has decided that Visa's charging too much. And actually, I've read several articles. There's a lot of small businesses complaining about some of these charges too. I'm not an expert in this area, but Amazon has decided to discontinue taking Visa in the UK. And there's been some talks that they might discontinue taking Visa here in the US. Probably negotiating stance that this will get worked out, but in the interim, Amazon's a huge retailer, and so Visa has had a pretty good drop. And again, when there's only 30 stocks, you're going to see a bigger hit to that index. So I think that's what's going on. Really, during the heavy part of the pandemic, the Nasdaq did better because it had more companies that could operate in that environment. Right now, the Nasdaq's doing better because there's more companies in there that can operate in that environment. Same thing, so it's it's really an interesting situation as far as that goes. But it all works its way out over time. Those things tend to cycle around. The Dow will probably catch up at some point here in the future, but right now it's lagging a little bit.
Do you ever feel there's kind of like a narrowing of the market right now because of the supply chain? So you really starting to focus on companies that can don't really need a physical supply chain, or they have control of their prices and stuff like that. And so you should we steer away from companies that need physical supply chains?
Yeah. So last year during the pandemic, there was a whole section of the economy and those companies that couldn't operate. Airline miles were down 96%. And what it did is it left these other companies that could still operate. And so there was a narrowing. And so if you have a same amount of money coming into the market, for example, and you've got less stocks, you're going to see more push, right, on that section. And then this year, when the vaccine came out and everything, mid-February through maybe mid-June, there was this big dispersion of money, and the entire river opened up, and it was really impossible to find trends because it was going all over the place. What's happening right now is we're getting back into this narrowing, and some of these companies that really are going to be affected by inflation, are going to be affected by the supply chain or the labor shortage, are lagging, right? And the companies that do better, you're exactly right. There is a narrowing, and that's what we're doing. We've narrowed some of the pieces of the portfolio. We've bought some specific companies, just like we did last year. We bought Microsoft and Nvidia, for example, because I think that those both, in different ways, are benefiting from what's happening here in this particular environment. They both have a good capability to do well here going forward, too, even if it gets worse. Hopefully, right? I mean, we never know for sure what's going to happen, but so that aspect is exactly right, and we're starting to see these trends come back, and so we're starting to actually see some jumps in our portfolios because it's moving back to the things that did well before. I suspect that it'll all wash out again at some point in time. Supply chain issues get worked out, labor issues get worked out, inflation kind of moderates because of that. And then we'll start to see more dispersion of the money across more stocks, and those trends will start to disappear again. And if that happens, one of the things I learned this year, if that happens, you want to get back into that total stock market index and not so much the narrow ones, because the money's just going to be going all over the place and it'll be hard to really track it or take advantage of it, and you just want to capture the entire flow. You buy, the Vanguard Total Stock Market Index or those types of things. Right now, what we've done is gone back to some of the narrower pieces just because it's working. And I think you're exactly right. Because of this scenario, the big money is starting to look at companies and see how they might, what happens if inflation comes and keeps coming and keeps coming? Will that company be affected on their earnings? Yes or no? And, most of it's a guess, but there's some companies that seem to have better pricing power than others. And those ones with better pricing power are probably getting more money right now. And that's what we've been focusing on. So, yeah, there's a little bit of a shift that's happening right now. And I've been talking about that in my daily videos too. I think it's an interesting area. So, all right. Well, that's the end of the show here. I want to thank everybody so much for coming. And again, we won't be here next Friday. You can subscribe to this channel, though. We'll keep putting content on here that you can get. You can schedule an appointment with us if you'd like to, meet with us by hitting that book appointment button on our website. Set up a 30-minute phone call or what have you with us, and we'll be able to talk to you directly. So look forward to seeing you in a couple of weeks. Thank you for joining us today.